Something has shifted in the financial markets. Not overnight, not suddenly, but with the kind of quiet persistence that separates genuine inflection points from temporary noise. If you hold silver, or if you've been watching it from the sidelines, wondering whether the years of patience would ever pay off, the landscape has changed in ways that deserve your attention. This isn't about hysteria. It's not about guarantees or predictions that someone discovered a secret the entire market missed. This is about recognizing patterns that have repeated throughout financial history, understanding the forces currently reshaping monetary conditions globally, and thinking clearly about what comes next. The metal that's been called undervalued, overlooked, and overshadowed for most of the past decade is now sitting at a technical and fundamental crossroads that serious analysts are taking very seriously. But before we discuss what this means for your portfolio, we need to be clear about what this conversation is and what it isn't. This isn't financial advice. I'm not telling you what to do with your money. What I'm offering is context, perspective, from someone who's studied these cycles, and a framework for thinking through what's unfolding right now in ways that most casual observers are missing entirely. Because the truth is, most people won't understand what's happening until it's already happened. And by then, the opportunity to position thoughtfully will have passed. Let's talk about why this moment is different, what the data is actually telling us, and how to think clearly during a period when emotions and headlines will try very hard to push you off course. Silver has broken above key resistance levels that it's tested repeatedly over the last several years. These aren't arbitrary numbers drawn on a chart by someone hoping to be right. These are price zones where buyers and sellers have battled for position, where institutional memory sits, where previous breakouts failed and rallies reversed. When an asset finally clears a level it's tested and failed at multiple times, it signals something fundamental has changed in the balance between supply and demand. Either new buyers have entered with conviction, or previous sellers have exhausted their position, or both. What makes this moment particularly significant is that it's not happening in isolation. Silver is moving, while gold is also pressing against historical highs. While central banks globally continue expanding their balance sheets, despite public messaging about tightening. While government debt in major economies continues accelerating at rates that would have seemed unthinkable a generation ago. While inflation, despite official narratives, remains structurally embedded in the system in ways that benefit debtors and punish savers. This convergence of factors creates conditions where precious metals historically don't just move, they move dramatically. But here's what you need to understand before we go further. Markets don't move in straight lines. Technical breakouts fail. Momentum stalls. Assets that look unstoppable today can consolidate or pull back tomorrow. Anyone promising you a simple, linear path higher is either naive or dishonest. What we're discussing is probability, not certainty. We're looking at conditions that have historically preceded significant moves in silver, while acknowledging that history doesn't repeat exactly, only rhythmically. So when I say a massive price move appears likely, I mean that the risk-reward profile has shifted in ways that warrant serious attention from anyone who understands how monetary cycles work. Not that tomorrow or next week or even next month will deliver the kind of explosive move that changes everything. Patience will matter more than perfect timing. To understand where silver might be heading, you have to understand where we are in the larger monetary cycle. The world's major economies have been operating under extraordinary monetary conditions for over 15 years now. Since the financial crisis of 2008, central banks have pursued policies that previous generations of economists would have considered experimental at best, dangerous at worst. Quantitative easing, zero interest rate policy, negative real rates, direct monetization of government debt. These aren't temporary emergency measures anymore. They've become the permanent architecture of how modern fiat currencies operate. Every time authorities attempt to normalize policy, to raise rates meaningfully or reduce balance sheets, something breaks. Markets seize. Liquidity dries up. The system that's been built on cheap, abundant credit starts revealing its fragility, and so the cycle continues. Another crisis, another round of intervention, another expansion of the monetary base. This matters for silver because silver, despite its industrial uses, functions historically as monetary metal. Not as efficiently as gold, not with the same central bank demand, but as a store of value that cannot be printed, diluted, or politically manipulated. When confidence in fiat currency systems begins eroding, not catastrophically but gradually, silver benefits from the same flight to real assets dynamic that benefits gold, real estate, commodities, and other tangible stores of value. We're seeing that erosion now, not in hyperinflationary collapse, but in the quiet realization among institutional investors and sovereign wealth managers that the purchasing power of major currencies is being systematically degraded by policy design. Look at what's happened to the dollar's purchasing power over the last 5 years alone. Look at what central banks are actually doing with their reserves, not what they're saying in press conferences. Look at the trajectory of government debt relative to GDP in the United States, Europe, Japan, China. The numbers tell a story that's very different from the narrative you'll hear on mainstream financial news. Silver is also responding to genuine supply and demand fundamentals that have tightened considerably. Industrial demand for silver in solar panels, electronics, electric vehicles, and medical applications continues growing while mine production has largely plateaued. The marginal cost of production has risen. Secondary supply from recycling hasn't filled the gap. Meanwhile, investment demand that disappeared during the long consolidation of the 2010s is returning. Exchange-traded products are seeing inflows. Premiums on physical silver coins and bars remain elevated. Delivery times have stretched. This isn't speculation. This is observable market behavior that indicates more buyers than sellers at current prices. And perhaps most importantly, silver is beginning to move in ways that attract momentum traders and technical followers who don't care about monetary theory or industrial fundamentals. They care about price trends and breakouts. When that crowd enters, moves accelerate, volatility increases. The price can detach from fundamentals temporarily as positioning and sentiment take over. This is both an opportunity and a risk, and we'll discuss how to think about both. The biggest mistake people make with silver is treating it like a stock or a short-term trade. They buy hoping for quick returns, get frustrated during the inevitable consolidations, sell at exactly the wrong time, then watch and regret as the next leg higher begins without them. Silver doesn't work like technology stocks or cryptocurrency. It doesn't respond to earnings reports or product launches. It moves on macro cycles that can take years to develop and months or even weeks to play out once they begin. The people who succeed with silver are the ones who understand they're not trading volatility. They're positioning for a shift in the monetary regime that may take years to fully unfold. Another common misunderstanding is that silver needs some catastrophic event to perform. Financial collapse, currency crisis, hyperinflation, war. History shows something different. Silver performs best not during chaos, but during the period when thoughtful investors recognize that chaos is becoming more likely and begin repositioning before the crowd. It's a leading indicator of concern, not a lagging indicator of disaster. You also hear people say that silver is manipulated, suppressed, held down by shadowy forces that will someday lose control and allow the real price to emerge. There's truth and fiction mixed in these narratives. Yes, precious metals markets have been subject to manipulation. This has been proven in court cases and regulatory settlements. Banks have paid fines for spoofing and price manipulation in these markets. But believing that manipulation is the only thing preventing silver from reaching some arbitrarily high price is a dangerous mental trap. It removes agency from your own analysis. It turns investing into faith rather than probability assessment. Markets are messy, imperfect, influenced by many actors with different motivations. Understanding that complexity is more useful than waiting for some mythical day when manipulation ends and justice prevails. The practical question isn't whether markets are fair. It's how to position yourself intelligently within the markets that actually exist. Finally, people misunderstand the relationship between gold and silver. They're correlated, yes. They often move together, yes. But silver is not just poor man's gold or a leveraged play on gold's direction. Silver has its own supply and demand dynamics, its own industrial base, its own volatility profile, its own investor psychology. When precious metals bull markets develop, silver tends to outperform gold on a percentage basis, but it also draws back harder during corrections. It whipsaws more violently. It requires stronger conviction and tolerance for volatility. Understanding what you're actually holding, rather than what you wish you were holding, makes all the difference. If we look at previous precious metals bull markets, certain patterns emerge that are worth understanding. They don't begin with clarity, they begin with skepticism. The early stages of major moves in gold and silver are characterized by disbelief, media dismissiveness, and general investor apathy. This is actually rational. These assets have often been in long consolidations or bear markets before the turn happens. People have been burned. Trust is low. The narrative around precious metals is usually negative. But underneath that narrative, fundamentals are shifting. Central bank policy is shifting. Currency dynamics are shifting. And a small group of investors who pay attention to those shifts rather than popular opinion begin accumulating. The initial breakout, when it comes, is often met with calls that it won't last. Technical analysts declare resistance levels that seem insurmountable. Skeptics point to every reason the move should fail. Some of those skeptics are right in the short term. Breakouts do fail, markets consolidate, pullbacks shake out weak hands. But when the fundamental drivers are genuine, when the macro backdrop truly supports a revaluation of hard assets relative to paper assets, those pullbacks become opportunities rather than failures. The middle phase of a precious metals bull market is where the real gains happen. This is when the trend is established enough that momentum players enter, when retail investors who miss the early move decide they can't stay on the sidelines anymore, when media coverage shifts from dismissive to interested to excited. Volatility increases during this phase. Daily moves that would have seemed dramatic in the early stages become routine. Corrections that would have ended the move in year 1 just become pauses in year 2 or 3. Psychology shifts from, why would anyone own this, to how high can this go? And that shift in psychology is precisely when discipline becomes most important. Because the final phase of these moves, historically, is characterized by euphoria, overextension, and eventually exhaustion. Prices detach from fundamentals. Everyone has a story about how high silver could go. New investors pour in having done no research, simply chasing momentum. Leverage increases. Speculation overwhelms investment. And then, as always happens, the move ends, sometimes with a sudden reversal, sometimes with a grinding top. But it ends, and those who bought emotionally near the peak suffer significantly. Understanding these phases doesn't let you time them perfectly. Nobody can. But it does let you recognize where you might be in the cycle, adjust your expectations accordingly, and avoid the emotional extremes that destroy wealth. Right now, based on the technical picture and the macro backdrop, we appear to be somewhere between the early breakout phase and the beginning of the momentum phase. That's not a prediction. It's an assessment based on observable market behavior and historical pattern recognition. If that assessment is correct, and it may not be, then the most significant gains may still lie ahead. But so do the most significant risks of getting caught up in euphoria and abandoning discipline. Both can be true simultaneously. If you've been holding silver through the long consolidation of recent years, you've already done the hardest part. You held through doubt, through boredom, through friends and family questioning why you own a metal that just sits there. You held while Bitcoin made millionaires, while technology stocks soared, while everything else seemed more exciting and profitable. That patience may be about to pay off, but only if you don't abandon it now. The temptation as silver begins moving will be to sell too early, to take profits and feel smart, to lock in gains before they disappear. This is understandable. Nobody ever went broke taking profits. But nobody ever captured life-changing gains by selling into the early stages of major moves either. You need a plan. Not a vague intention, but an actual plan with specific criteria for when and why you might sell portions of your position. Are you holding as monetary insurance? Then selling during the early stages of monetary stress makes no sense. The insurance is needed most when the conditions it was purchased to protect against are actually occurring. Are you holding for investment returns? Then you need price targets based on something more than emotion. Historical ratio analysis between silver and gold, production cost multiples, technical resistance levels, percentage gain thresholds. Write down your plan now before emotions intensify, because they will intensify. You should also be thinking about position sizing relative to your overall portfolio. If silver was 5% of your holdings when you bought it, and it's now 10 or 15% because of appreciation, do you rebalance? Do you let it run? Do you take some off the table and diversify elsewhere? There's no single right answer, but there is a wrong answer, and that's not thinking about it at all until panic or euphoria makes the decision for you. Remember, too, that volatility works both ways. A breakout doesn't mean straight line appreciation from here. Expect pullbacks. Expect moments of doubt. Expect media narratives that declare the move over. If your conviction is based on fundamentals and macro understanding rather than just price momentum, those pullbacks won't shake you. They'll just be noise. But if you bought because someone on the internet said silver was going to explode, you'll probably sell at exactly the wrong time. Know why you own what you own. Revisit that reasoning regularly. Adjust as conditions change. And please don't let a winning position turn you into a zealot. The most dangerous thing success can do is convince you that you figured out something everyone else missed, that the rules don't apply to you, that this time is different in ways that justify abandoning risk management. Silver can go much higher than current levels under the right conditions. It can also pull back sharply before continuing higher. It can enter a prolonged consolidation that tests patience all over again. Stay flexible, stay humble, stay disciplined. If you're watching this breakout without a position, you're probably experiencing some fear of missing out. That's natural. That's human. The question is whether that fear should translate into action. Here's what you need to understand. Buying into a breakout after a major move has already occurred is exactly how most retail investors lose money. They wait for confirmation, which means they wait for the price to prove them right, which means they buy high. Then the inevitable consolidation or pullback happens, and they sell low. If you're going to enter a position in silver now, it cannot be because you're chasing momentum. It has to be because you understand the fundamental case, believe the macro backdrop supports higher prices over time, and are willing to tolerate significant volatility. You also need to think seriously about position sizing. This is not the time to go all in on silver because you're afraid of missing the move. This is the time to build a position thoughtfully, in stages, in a way that lets you sleep at night. Consider starting with a small allocation, something that if silver doubles, you'll be happy you participated. But if silver pulls back sharply, you won't be financially or emotionally devastated. Then add to that position on weakness, not strength. This requires discipline that most people don't have. It requires buying when it feels wrong, when the price is dropping, when media narratives turn negative again. But that's how wealth is built in asymmetric assets, by accumulating when others are fearful or disinterested, and holding when others are euphoric. You should also be educating yourself significantly before deploying any capital. Understand what you're buying. Understand the difference between physical silver and paper silver. Understand storage, premiums, liquidity, tax treatment. Understand the macro forces driving precious metals. Understand monetary history. Understand what happened in the 1970s, the 2000s, during periods when hard assets outperformed paper assets. You don't need to become an expert, but you need to know enough that your conviction is based on understanding, not hope. And critically, understand what you're not buying. You're not buying a get-rich-quick scheme. You're not buying a guaranteed outcome. You're not buying something that will only go up. You're buying optionality on a macro outcome that many serious investors believe is becoming more probable. A revaluation of hard assets, a recognition that currency debasement has consequences, a shift in how sophisticated capital allocates between paper and tangible wealth. If that outcome unfolds, silver could perform extraordinarily well. If it doesn't, or if it takes much longer than expected, silver could languish or decline. Assess that probability for yourself. Decide how much of your capital belongs in that trade. Then execute with discipline and patience. Anything else is gambling, not investing. Let's talk about the mistakes that will destroy people during this move, whether they own silver or not. First, do not leverage yourself into silver. Do not buy on margin. Do not take out loans to purchase precious metals. Do not use money you need for living expenses or upcoming obligations. When volatility hits, and it will, leverage amplifies losses in ways that can force you out of positions at exactly the wrong time. The irony of leverage is that it usually causes people to realize the very losses they were trying to avoid. Second, do not listen to price predictions from people on social media who claim to know exactly where silver is going. Nobody knows. Anyone claiming certainty is either delusional or selling something. You'll see targets of $50, $100, $500 per ounce. Some of these might even prove accurate eventually. But their guesses dressed up as analysis, and organizing your financial life around someone else's guess is foolish. Third, do not make silver your entire portfolio. Diversification isn't exciting, but it's the difference between surviving volatility and being destroyed by it. Even if you believe deeply in the precious metals thesis, even if you think silver is the trade of the decade, you need other assets. You need liquidity. You need balance. Fourth, do not react emotionally to daily price movements. Do not check the price every hour. Do not let your mood rise and fall with the charts. If your position sizing is appropriate and your time horizon is measured in years, not weeks, daily volatility shouldn't matter. If it does matter, if it's affecting your sleep or your stress levels, your position is too large. Fifth, do not assume that because something has gone up, it must keep going up. Trees don't grow to the sky. Every bull market ends. Every breakout eventually consolidates. Plan for success, but also plan for the possibility that you're wrong, that the move stalls, that conditions change in ways you didn't anticipate. And finally, do not ignore the rest of your financial life because you're focused on silver. Don't neglect your career. Don't stop building skills. Don't abandon other investments or opportunities. Silver is one piece of a financial strategy, not the strategy itself. Treat it accordingly. We're living through a period of extraordinary monetary experimentation. The decisions being made by central banks and governments today will shape the value of currencies, assets, and savings for decades to come. Silver, along with gold and other hard assets, offers a way to position for outcomes that thoughtful observers consider increasingly probable, not certain, probable. If you hold silver, stay patient and disciplined. If you're considering it, educate yourself and move deliberately. If you're skeptical, that's fair, but stay informed about why some very serious investors are paying attention. The move we're seeing in silver may be the beginning of something significant, or it may be another false start that tests conviction and patience all over again. What matters isn't predicting which one it will be. What matters is understanding the forces in play, managing risk appropriately, and maintaining the emotional control to make good decisions, regardless of what happens next. The investors who succeed in environments like this aren't the ones who predict perfectly. They're the ones who prepare thoughtfully, position sensibly, and adapt intelligently as conditions evolve. Stay informed. Stay disciplined. And remember that understanding cycles matters far more than reacting to noise. Thank you for watching.